Hello, good afternoon. Welcome to MF Corner on CNBC TV 18. I'm Vinny Motiwala and with me my colleague Sonal Bhutra, as always. Sonal, good afternoon. Today we have AMFI data that's come in as well and important updates that have come in here as well. But first,
Oh yes, good afternoon. And the big talking point has to be what's happening with gold ETFs, the way silver ETF flows have increased. And now they're topping equity funds. In fact, them combined together are more than equity fund flows. So that's the big headline that we are taking from today. But to take a few questions and understand what's happening here, we have Prableen Bajpai, who's the founder of FinFix Research and Analytics. Prableen, good afternoon. Thank you so much for joining in. The big question has to be around the gold ETF and silver ETF funds. Gold ETF is now as much as equity fund flows. Do you think this is a FOMO trade that happened in the month of January and it has topped or peaked now and we could see fall, and this fall could be steeper in fact?
Hi, good afternoon, Sonal. Such amazing figures. It's really interesting to see how the gold inflows have topped this month for January. Amazing. So let's give a bit of a background, Sonal. This also comes at a time when I think a lot of factors have actually helped push this data upwards, because I think you don't have any availability of SGBs. I mean, new schemes are not being launched. We've seen rupee depreciation, so gold prices, going up. We've seen weak equity markets as well. And there is some news or the other on the geopolitical front. So I think with all of these factors, gold and the kind of returns that it's shown in the recent past, definitely, a lot of investors have been not only perhaps, it would be wrong to say that everybody is looking to chase past returns, Sonal, but definitely it is also at a time when people perhaps realize that this asset has to be there in their portfolios and probably just trying to add that little bit there. And I think another very important factor is also that, 2 years back, we had that change in the taxation when gold became taxable at slab. Last year, 2024, that was changed. 25, sorry, that was changed. And this year, now we know that it's taxable at equity. So I think all of these factors cumulatively are helping gold. But of course, the data is spectacular. We haven't seen anything like this. December, we had about close to 12,000 crores come in. This month, it has been 24,000 crores. So I don't think this sort of an inflow is sustainable, Sonal. But, given the trend, if you're looking at the fall in the equity markets, which started in September 2024, the correction phase, till now, Nifty is still down 1.13% and gold is up 100%. So I think, it's very natural for investors to somewhere move towards an asset class which feels safer, which has delivered returns. And so not the same level of sustainability perhaps going forward, but I think some addition of gold definitely should be there in all portfolios, but from a very long-term point of view and with moderate return expectations going forward.
absolutely. That is key, right? Moderate level of expectations in terms of returns. We are not going to get every year that we saw as 2025 and right now for a gold returns as well. Probably in good afternoon. You said that obviously everyone wants a part of gold now. So in some way, multi-asset allocation funds have also been in trend for a while. Even in Jan AMFI data, if you look at it, we've seen a very sharp jump up. Inflows coming in over there, also highest ever, 10,485 crores. Your thoughts on multi-asset allocation fund? And is it a better play maybe to look at multi-asset allocation funds versus gold ETFs also?
So multi-asset allocation funds, I think, Vinny, have always been, a very good category, especially during downturns. If we look at previous data also, for example, the last two falls post-COVID, when we saw Nifty correct by 15-16%, which was, October 21 to June 22, and then September 24 till roughly March, April of 25. With both these falls, we saw that good multi-asset funds were able to contain that 15-16% fall in Nifty at as low as 3 to 5%. So almost 1/3 of the fall, 1/5 of the fall, Nifty's fall was contained. So I think given those kind of downside protection, which multi-asset funds, some of them, not all, of course, showed, I think, naturally, even in times when equity markets are not doing well, there was a natural inclination to move towards something which can contain the falls. At the same time, the returns for multi-asset allocation funds, if we look at during the same time period, it's interesting to see that when Nifty has delivered negative 1.5% since September of 2024, majority of the multi-asset funds have given 95% of the time have delivered actually double-digit returns. Only one of them, the lowest returns in the category for this time, these 14, 15 months is actually 7%. So multi-asset funds, again, Vinny, makes great sense, to have it in the portfolio because the fund managers have that flexibility to reduce your silver, reduce gold. If they feel that, these segments are getting overheated, they can move into bonds and equity. And I think it can be a great way actually to take exposure to gold and silver, only if you, leave it to the fund manager. But of course, I think, again, return expectations from even this category overall has to be now, it may not be the kind of returns that we've seen in the recent past because, these assets, silver and gold, have actually really, really supplemented the returns over there.
Makes sense. A lot of it came from precious metals, right? Be it in multi-asset funds or gold ETFs and silver ETFs that we've been talking about. The other part that we speak about very often in the market language is the mid and small caps. These funds have seen a decline month on month, despite an indication that maybe mid and small caps, after reporting good earnings, could start to recover. Is that an indication that we're getting despite the decline that we saw on a month-on-month basis? What explains that?
So I think, Sonal, honestly, I feel that retail investors have shown a lot of resilience, in the face of very sort of turbulent markets, especially in the small cap space. What we see today, let's say 2-year-old SIPs, 3-year-old SIPs in small caps, mid caps show very meager or low returns. If you're just looking at the movement of, since September 24 till now, we still see that a lot of small cap funds are in negative. So considering the kind of performance we've seen in these segments, I feel that the little dip that we've seen in these two segments is not bad. Actually, it's lesser than what we've seen in the previous months because somewhere maybe, there is some bit of tiredness which starts to setting. There's a bit of frustration as well when you've, given you've continued with your SIPs and the returns are still negative 5%, 7%. And at a time when some of the other assets like gold, silver, especially silver, like plus 160% returns, they're shining. And then with, I think, limited assets, how much does a retail investor have? So you definitely can have the tendency to, move and allocate from one category to another. So I think that is understandable. But I think still the mid cap and the small cap data is decent given the current market conditions.
Prableen, anything else that stands out for you in the AMFI data as well? Also, debt funds, that also seems to be the flavor or, continue to be the flavor as well. Your thoughts on that as well?
So with debt, especially liquid, Vinny, there's always a lot of seasonality. So, tax seasons and company big money coming in certain times. But if you're looking from, investors that we speak to, debt definitely has lost a bit of its charm. And I think that is also where maybe categories, especially the conservative categories, for example, some of the balanced advantage funds or those multi-asset funds which are having lower component of pure equity have attracted investors. And of course, within hybrids, there are other categories. So I think overall, that little bit of AUM shift is there. Although I feel in the debt space, it is mostly the overnight and the liquid funds which actually, really move the overall data. And that comes in from corporates. But from, I think, retail investors' point of view, I don't think that they've been able to make a major dent there. But I think the hybrids are definitely getting that advantage. We do have newer categories. We'd also have things like fixed income plus arbitrage, all these categories which are more tax efficient, which are giving us a combination of fixed income plus, equity taxation. So I think for investors, that's big. And of course, silver, I think that's one thing which has attracted so much. I mean, amongst all the data which has come in, not only that gold is equivalent to the equity inflows, that's something that Sonal already mentioned. And other than that, I think the increase in the number of schemes for silver which have been launched overall, that's something, last year we had about 8 schemes in silver. Now we have 14. And the rise in the AUM of certain schemes, Vinny, for example, SBI, the FOF, for silver moved up from like 300 crores to almost 5,000 crores. ICICI saw that big jump, doubling its AUM. Nippon just from 500 crores to close to 4,000 crores. So I think all of these things definitely show that there is a bit of recency bias, but there's also a
Okay.
shift that investors are doing.
Take that point, Prableen. Always a pleasure speaking with you, but we are out of time, so we'll take this conversation ahead some other time. With that, we'll slip into a short break. On the other side, we speak to Raghav Iyengar, CEO of 361 Asset Management. Welcome back. You're still tuned into MF Corner on CNBC TV 18, where we talk about mutual funds. But one category that the AMFI website now also talks about is SIFs. And that is an interesting one that came in with effect from 1st April of 2025, which was a new category which was introduced by SEBI, where a minimum threshold of 10 lakh, that's a minimum investment amount that is to be made by an individual. It is to bridge the gap between mutual funds and PMS, or portfolio management services. It allows for long-short strategies. There'll be sectoral rotations, dynamic asset allocations, offering greater portfolio flexibility. So it's basically somewhere in the middle of PMS and mutual funds as well. As per the data today that we got, the total AUM of SIF stands at 5,729 crore rupees. So it's still in the nascent stage, but we do have some of them which have been launched already. There's Edelweiss AMC, which has launched the Altiva SIF. Bandhan AMC has done it with Arudha. Divinity from ITI AMC. There's ISIF from ICICI Sepru, Magnum from SBI MF, Titanium from Tata AMC, QSIF from Quant MF, and now we have Dyna SIF, which will be launched by 361 and asset management. And of course, this is an interesting category, still, as I said, in the nascent state. So it will be good to understand more about the nuances, who it is suitable for, what kind of risks would be involved, and a lot more.
Absolutely, and to discuss all of that, we have Raghav Iyengar, CEO of 361 Asset Management, joining us right now to talk to us about that. Thank you so much, Raghav, for joining us this afternoon. Let's just start by talking about the basics. Why should an investor consider SIFs instead of mutual funds or PMS?
Superb question. You always start off with the bouncers, right? I think the interesting thing about this category is that it's actually at the intersection of mutual funds and maybe alternate investments or PMS. So you have the simplicity, the taxation, the transparency of mutual funds. And of course, you have innovation in the form of derivatives usage which is typically given to very, very high net worth individuals, typically investing in AIFs and PMS. That intersection has actually come together and created this lovely category called specialized investment funds. So actually, it's a fairly path-breaking category. Typically, you can really make money in some interesting situations here. Potentially there is ability to make money even when the markets are falling through use of some innovative derivative strategies, which frankly you cannot do in the MF segment as per regulation. So I think it's a fabulous category. In fact, I was just listening to the monthly flows, and I think at some point of time, this category will also surprise you and will be a very, very larger part of the overall AUM of investors.
Okay, all right. So in that case, let's understand more about this, Raghav. How does the long-short SIF help manage risk versus, say, a regular equity fund?
Yeah, so typically, I think there are three ways, right? I think the biggest thing is that you can do some level of downside protection, as I said, using some amount of derivatives. The regulation allows the scheme to go 25% short, which means basically that if I feel that, or if the fund management team feels that there is a sector which is overvalued or stocks are possibly out of their earning cycle, there is a potential way to make money when the stocks are actually reducing in value. Typically in long only funds, you typically stay out of these stocks, or at best you buy yourself in cash. Now let's look at a sideways market, which, say, for example, happened last year in 2025. You all know returns were fairly flattish. I think there you can create some earning capability by doing, again, derivatives, by taking some long short positions, by taking some index futures, taking some index arbitrage, and adding to some amount of the portfolio return. But the core of this business, again, is the fact that you will make the bulk of the return will come from long only strategies, because the way the structures are, these products are structured, is that you have to be let's say in the equity long short category, you have to be 80%, minimum 80% long, and up to 25% short. So this just adds on to potential returns, basically. So.
Raghav, which SIF category should investors actually look at now?
That's back to basics question, Vinny, because I think, there are three categories largely here. Like mutual funds, there's an equity category, there's an hybrid, and there's also fixed income or debt category, right? I think most of the launches have happened around hybrid and a few in equity. But really, it's up to the investors' risk appetite, time horizon. And, there are in mutual funds, different categories, different strokes for different folks. The same logic applies here in SIFs too. So let's say if I am a risk averse or a conservative investor, I have the option of looking at investment into hybrid categories. And there are two categories. There's the equity, hybrid, long short. And of course, there's the asset allocator, which both of them are similar to, let's say, multi-asset funds and, hybrid funds today. So in that sense, there is an ability to marry your risk appetite, your investment horizon to the products offered. There are 7 subcategories, as you know. There are 3 in equity, there are 2 in fixed income, and there are 2 in hybrid. So the important thing is to try and figure out what the product is doing for you. Does it fall into the high risk category? The same riskometer applies here. So if you go to any scheme offer document, you will see the same risk bands 1 to 5. Marry your risk, marry your investment appetite, marry your time horizon, and yes, hopefully enjoy the journey.
Okay, so we'll keep asking a lot more basic questions because as you also said, it's a nascent category or an asset class, and you expect it to grow. So it's very important to understand those nitty-gritties as well. So say somebody already has investments in mutual funds where you don't need a 10 lakh corpus, right? You can do it with as much as 5,000 or 100 or 200 as your monthly SIPs. But here you have to put out a big amount of corpus. So at what level of investment journey should investors look at SIPs in their portfolio? It wouldn't be for a first-time investor, right? So how do you take so many factors together to understand whether SIPs are right for you? Of course, the subcategories come in later, but this is the product for you. How do you make sure of that?
I think critically, let's do it the reverse way. So let's try and figure out who this is not for. So obviously, it's definitely not for somebody who's coming into capital markets or mutual funds for the first time. Irrespective of all the marketing and all the jargon, I think very clearly it's definitely not for somebody. Somebody who's already got a core mutual fund portfolio is looking to diversify beyond traditional mutual fund investments. I think that's the place to go to. Obviously, because it's a 10 lakh rupee minimum, it is catering to a slightly more evolved, educated audience, people who've already got hopefully money at play in capital markets. And then obviously it's in that sense, obviously then you get into the relevant product categories, look at the risk meter, and then figure out whether that really meets your time horizon. So let's say if you're in an equity long short, typically the risk band will be 5. I mean, that's the highest risk band. So ideally, very, very sophisticated investors, possible chance of capital diminution. So hence you have to give that time horizon of at least maybe 3 years, 5 years plus, and be prepared for times when the portfolio doesn't do anything for you.
Okay, and what about costs in general? How does the costing work here for an investor versus say a mutual fund?
It is pretty much identical, so there's no difference. That's the beauty of this product, because you've basically taken all the good things of mutual funds, which is the transparency, the regulation, the cost structure, the portfolio disclosures, everything, and sort of try to put it into a new category, which sort of combines mutual fund transparency with sophisticated investment techniques, which are possibly available for maybe in the alternate investment or the portfolio management space.
Okay. Raghav, thank you so much for joining us on the show this afternoon, explaining us this category, which is relatively new, but increasing in terms of the pace that we're seeing for interest. Thanks so much for joining in. But with that, we're absolutely out of time on this edition of MF Corner. Thank you so much for tuning in. Up next, we're closing.